In today's video, we're going to talk about how the recent interest rate hike of 1% is going to impact the real estate market and the overall economy. First, we're going to start with the Bank of Canada's perspective, and then I'll share my thoughts on it, as well as how we're seeing some very curious things happen with the mortgage amortizations on variable rate mortgages. And we're actually seeing on one of my mortgages an amortization as long as 60 years, which is a very curious phenomenon. If you're new to my channel, my name is Koukun. I'm a real estate investor and I run a real estate team here in the Niagara region that helps investors buy and sell investment properties. If you're curious to learn more about what we do, I have a link in the comments below for our beginner's guide to investing in the Niagara region. All right, let's get started with a clip from the Bank of Canada presentation here.
I'm going to ask Senior Deputy Governor to say a few more words specifically about the housing market.
Thanks, Governor. So I think it's important to step back a bit on housing and look separately at the effects of rising interest rates on individual home buyers and on the housing economy or the housing market itself and its effect on the broader economy. So at the individual level, we know that there's a segment of home buyers, particularly those that got into the housing market more recently, and they might have stretched to do so, and they may be sitting in a variable rate mortgage. And for those people, when interest rates go up, there's an immediate effect on their payment, and there's no doubt they're being squeezed. But that is a small segment of the population, not to minimize the effect on that segment of the population, but just to put it in the context of the overall economy. A reminder on some important numbers we've given you before. 65% of Canadians are homeowners, 35% have a mortgage. The vast portion of those are fixed rate mortgages, so their payments don't reset when interest rates move. About 10% of mortgages are variable, and of those, most have a fixed payment. So the effects of interest rates on most mortgage holders is not immediate. Of course, each year a portion of mortgages will renew, and so those payments will reset, and they will reset at a higher level with interest rates going up. Also worth adding here that we know that regulations require lenders to test mortgage holders for higher interest rates, so there is a buffer in there meant for exactly the situation when interest rates raise. At the broader economy level, housing is a segment of the economy we know is very interest rate sensitive. Most people who buy a house borrow money to do so, so housing activity is very sensitive to changes in interest rates. When housing activity and prices are high, it feeds through to the broader economy. People are more likely to renovate. They buy things that go along with housing. They buy appliances, they buy furniture. And we also know that housing has an effect on Canadians' confidence. So they're more likely to spend just in general when housing prices are up. Of course, the opposite happens when interest rates go up. Spending is more likely to be constrained on things like renovations and goods, and people generally tighten their belts a bit when housing prices are going down. Right now, and for the last year, we know that housing activity and housing prices have been unsustainably high. Basically, a spike in demand, low interest rates combined with chronically low supply, and we've had very elevated housing prices. This is part of what's feeding into excess demand in the Canadian economy, and as the Governor said, our goal is to get that demand down, and part of restoring the balance of supply and demand in the Canadian economy is restoring that balance in the housing market, and that's what we're aiming to do. We do expect, as the Governor said, that changes in housing activity and prices will feed through to overall economic activity.
All right, so this is quite insightful just to hear the Bank of Canada's perspective. So we just heard from the Senior Deputy Governor, Carolyn Rogers. So her along with Tiff Macklem, I believe, are sort of on what's called the Governing Council at the Bank of Canada that decides the moves in interest rates. So what she mentioned, a small segment of home buyers who recently purchased, who may have stretched themselves and used a variable rate mortgage are likely to be the ones who are hurt the most. Of the population of Canada, 65% own a home, 35% rent. Of the 65%, 35% 35%. So I'm guessing roughly half of homeowners have a mortgage, of which the majority are fixed. So they have a 5-year fixed mortgage is the typical mortgage. And what you mentioned was roughly 10% of mortgages are variable. And even most of the variable rate mortgages only reset in terms of the monthly payment at the end of the 5 years or once they reach a threshold interest rate. So if you have a variable rate mortgage, many lenders, so I found a little article here, who offers fixed payment variable rate mortgages. So a fixed payment variable rate mortgage is very curious. All of my mortgages, except for one on my rental properties, are actually this kind of mortgage. So your monthly payment stays the same, even though it is a variable rate mortgage. So when the rates rise, I am paying a higher interest rate, but my payments stay the same. The way they do this is by stretching out how long the mortgage takes to get paid off, at least for the 5-year term that I have the mortgage for. So you can see here, here are the lenders with fixed payment variable rate mortgages. So you can see that many of the major banks, TD, RBC, BMO, CIBC are included. Scotiabank, it seems, has some fixed payment variable rate mortgages, but maybe not all. And then the ones that don't have it, the big ones here are National Bank and many of these A lenders. However, they're not the non-bank A lenders. So Home Trust, First National, Equitable, many of these don't have fixed payment. So if you don't have a fixed payment, as soon as rates rise, your payments go up. So this is where this very curious situation happens. So I currently have a mortgage that I refinanced back in 2020. So this is a $400,000 mortgage. Since then, the payment, the mortgage has been paid down to $380,000. So when interest rates were low, a significant portion of the mortgage payment went towards the principal. I think it was as high as 2/3 of the payment was paying down the mortgage every month. That has since dramatically changed. So you can see the interest rate now is 4.7%. So it has since adjusted as of yesterday. You can see the maturity date. So I got a 5-year variable closed mortgage. So I got it in 2020. Now it's going to expire in 2025. And it's a 60-month variable mortgage. So the original amortization here was 360 months, and it is now 766 months. And the curious part is already close to 2 years, over 2 years has passed. So this should actually be in the 320 range, but it has over doubled it. And if you look, 766 months divided by 12 is 63.8 years left. Now, obviously, this is not going to be a 63-year mortgage. At the end of the 5 years, the payments will reset. And I calculated roughly, if you have $380,000 left on the mortgage, if we look at the current interest rate of 4.7, if we put 25 years left, we're going to be looking at about 2,100. But at the end of the 5 years, I'll likely have the option to extend it out to 30 years as well. So this is pushing out the mortgage another 5 years. And then my payment will be about $1,960, which is still significantly higher than the current payment of $1,570. So close to 20-25% higher. So another aspect of what was shared is when interest rates rise, that has a direct impact on the housing market. So we're already seeing the housing market slow down because the segment, like the Deputy Governor mentioned, the segment of the market that is affected the most are the people who just bought, especially the ones who stretched themselves to purchase a home with a variable rate mortgage, but it also impacts the people who are going to buy right now. They need to qualify at a higher interest rate. The stress test has also increased. Before it was around 5%. Now it's 2% higher than the posted rate. So now it's going to be in the 6% range. So they now need to qualify at a higher interest rate. Even though housing prices have come down, interest rates have gone up. So it isn't necessarily any easier to buy a home. And this trickles through to the rest of the economy. So when the real estate market is affected, the resale market is affected, this trickles into, renovations, right? We're not yet seeing this yet. Most of our contractors are still super busy, but I'm expecting in the course of the next 3 months, 6 months, 1 year, there's going to be a ripple effect where a lot of people are no longer willing to do large renovations to their homes, to their investment properties, because the cost of borrowing is high. And as a result, and even housing prices coming down is tempering expectations of, I can put 50 grand into a kitchen and then the value of my home is going up 50 grand. That equation changes when the housing market is a lot softer. So people may be willing to spend less on renovations, on furnishings. And even when the house prices were going up dramatically, people were borrowing on home equity lines of credit to, go buy a boat, go buy purchases that were not necessarily investments. That's likely going to be tempered quite a bit as housing prices come down. So all that to say, there's likely going to be a ripple effect in the economy. We're already seeing the ripple effect in the housing market because the people affected the most are the people buying houses now and the people who've just bought. So the impact is there, but I'm fairly confident this is not going to go into a drastic correction like the one we saw in 2008. And the reason I say that is because of exactly what we've described. The percentage of people who have mortgages is 1/3 of the population. And of those people, most are fixed rate. So if there is going to be any kind of major correction in the housing market, it will likely come from a recession. So if the market and the housing market affects the economy to the degree that companies start laying off people and we go into a severe recession, once people start losing their jobs, that's when this becomes a downward spiral where people can start selling their homes because they have to, not because they want to. So that's a key thing to look for if there's a recession and how significant that recession is. Just the fact that the economy shrinks isn't going to cause a housing collapse. It's going to be the severity of that recession that I'm going to be watching for. And yeah, I think overall, these are uncertain times. If you are interested in purchasing a home right now, I would be very cautious. I would really look at your personal finances, how much of a buffer you have. I do think now is a time you're going to start seeing more deals. And if you are in the market to buy a home, you will be able to significantly negotiate on the purchase, and long term that can work out well. Even the Bank of Canada is expecting to reduce interest rates if they can get inflation under control. So even the current rates that they have right now are not rates that they necessarily want for the long term. And the sort of wild card in all of this is if we do have a recession that is significant, the automatic response from the Bank of Canada typically has been to reduce interest rates to sort of stimulate the economy. So it will be very curious to see, can they balance fighting inflation, which requires them to increase interest rates, and prop up the economy, which rising interest rates is hurting. So they may have to reduce interest rates to stimulate the economy. And if that happens at a time when inflation is significant, that's called stagflation, that can cause some very serious problems. The last time we saw this was in the 70s, and it had some pretty drastic implications. So a lot of uncertainty, a lot of changes that are happening. I'm personally keeping the rental properties that I have. I'm not selling anything. I'm not necessarily looking to buy right at this moment because I want to see the true impact of the rising interest rates come through the housing market to the point I can find properties that cash flow with the higher interest rates. I'm not yet seeing that. So that is a key factor that I'm looking for, and what I'd recommend all our investors to look for. If you're buying as a primary residence, if you find the perfect home in the perfect neighborhood, and if you can do so affordably, go for it, right? You always need a place to live. You're either renting or you're owning a home. So I think trying to time that is not necessarily the right move. But if you are an investor, I don't necessarily recommend timing the market, but I do believe in focusing on the fundamentals. So if a property cannot cover its expenses with these new higher interest rates, it's a speculative investment, and I personally shy away from that type of investment. If you can find a property in today's market based on negotiating the price down to the point you can have a good buffer of cash flow with the higher interest rates, I think it's still a good time to buy, as long as you can create that margin of safety with the cash flow. So hope you found this helpful. If you have any questions, feel free to comment below. If you're interested in investing in the Niagara region and learning more about what we do here at Team Koukun, check out our beginner's guide to investing in the Niagara region. And until next time, all the best.